Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller, looking at continued volatility in this rates market. It's pretty striking.
So we're not going to talk about your birthday?
No.
Okay.
No, we're going to ignore that. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. Today we're seeing, as I said, a bit of a reversal in treasury yields, but we had a 2-week-long march lower. We're going to talk with BlackRock's Tushar Yadava about how yields are affecting his outlook.
Plus, the latest on the timeline for the approval of a spot Bitcoin ETF. We're going to take a look at how it could impact the digital asset and the ETF industry.
And we'll speak to Michael Green of Simplify Asset Management on his firm's new ETF. They will introduce a strategy, a new MBS, mortgage-backed securities strategy.
But Matt, before we get there, Eric Balchunas from Bloomberg Intelligence, he's back. He's with us now. He's looking at the flows. What do you got?
Katie, Matt, thank you. It's good to be back. Looking at the flows this week, it's a bit of a barbell, right? You've got on the top of the list, on one hand, Bill, which is one of the most boring ETFs. It's 1 to 3 month treasury bills. You go there to hide out or to get yield now. 5% yield is attracting people there. It's actually a trade. 3.16, best of the week, and 7.5 for the month, best of the month. Then you go down, you get more risk on. You've got HYG, SPY, LQD, VU, IWM is small cap. You've even got the Qs in there. So definitely people want their equities, but they also want that, you know, as John Davi called it 2 weeks ago, to T-bill and chill in those short-term treasuries. Let's look at the outflows. You can see from the outflows, there's much less outflows. So net number of 24 billion at the top, that's good. The stuff that's seeing outflows, again, not that big. EEM is notable on there, emerging market outflows, and then a little bit of tech and a little bit of VNQ is real estate. So you definitely see some push-pull in the equities. It's not all one direction. But let's go and look at this ultra short-term sort of T-bill and chill concept. I went and ran the quarterly flows historically for ultra short-term debt ETFs, and look at what you see. The quarter is far from over, but already, if the quarter were to end, we would be at a record amount of flows into this sort of boring ultra short-term area, which kind of is polar opposite of the TLT trade that we've seen, which is still going on. So people doing all kinds of things in the flows this week, Katie.
Both ends of the yield curve, Matt, on fire right now.
Barbell.
There you go.
Right? I wanted to ban that term from Bloomberg surveillance, but we can use it on ETF IQ because we don't overuse it. Joining our conversation is Tushar Yadava, Director and Strategist at BlackRock, Multi-Asset Strategies and Solutions. Tushar, let me get your take first on the flows in terms of bill or T-bill and TLT.
Yeah, I mean, it's something similar that we've been doing in our portfolios since the summer, which is, that barbell word that you don't like so much. And clearly I'm a guy that looks like he lifts a lot of barbells. But
yes.
No, it's one of those areas where we manage multi-asset portfolios. We care about the stock as the sort of the gas, the driver of returns in that portfolio. So then you have to think about what your bond portfolio is doing to ballast out, to offset that, right? And for the longest time, we've had such a sort of volatile market in the long end of the rates, with reals driving sort of what we're seeing in rates, especially at the long end. Barbelling gives you that way to sort of modify your duration, keep yourself at sort of a point that you're satisfied with to give you an equity balance, gives you a sort of whoopsie. If things go wrong in the markets, it's sort of one of those uncorrelated.
Where do you want to be right now in terms of duration?
We're sitting ourselves closer and closer to the benchmark duration for us, but we're a little bit longer, and that's just really reflective of the fact that we're actually overweight stocks. So every time you want to be overweight stocks, you want to add a little bit more to your long duration bonds, as much as people don't like seeing it after the last year and a half, because it gives you that, especially in the last week, we've seen kind of insurance policy and gives you that kind of rates rally.
First of all, let's set the scene here and talk about what you actually do, because we were batting around some ideas. You're like the marionettist, you're like the puppet master. You sit on the model portfolio team at BlackRock, which is hugely important because you make shifts and financial advisors basically follow. So you mentioned that you're overweight stocks right now. When did you make that decision?
Yeah, this year we have started out overweight. We went underweight after Silicon Valley Bank with a little bit of the sort of uncertainty that we're seeing there. And pretty much after the summer, we've been starting to edge back into stocks, edge back in the mega cap range, into an overweight that is. Mega cap, technology, growth, these are areas that we're pretty overweight. And we've been overweight since the summer now on a drifted basis in our portfolios.
Yeah, Katie, when you see a flow come out of nowhere and it's like 1.5 billion, it looks like this and then bam, right?
That's the guy.
It's either him, Merrill, or the Bank of Japan. It's one of those three. Those are the three biggest ETF investors on planet Earth, as far as I know. you had a big flow a couple weeks ago that we pointed out into OEF.
Right.
This is interesting. This is the S&P 100. So I guess why narrow that off? I know you guys went into mid caps earlier in the summer. This would be going the other direction. You're actually overweighting the Super 7 stocks. What gives there?
Yeah, I think our view at the time was in the summer, if we see a broadening out after you've seen just such explosive performance from the sort of mega cap and tech names at the head of the index, that sort of mega cap 7, if we saw a broadening out, mid cap and small cap would be the area that would win. That hasn't happened, and we just look at the index, the composition of the index now, and we think going into year end now, we'd much rather own the largest cap names, sector by sector. If you threw a dart, we'd rather own the stock that's in the larger cap than it is in the smaller cap, because that's where we're seeing the positive earnings revisions, that's where we're seeing the balance sheet strength, and those are themes that we want to own right now.
It makes sense to you that we don't see wider spreads for high yields. We don't see wider spreads for IG. I mean, everything's pretty tight.
Yeah, and economic growth is sort of giving you that signal, right? We're seeing in the high yield space at least, right? I was looking at the terminal, I saw 16% that we've seen tightening in spreads year to date. It gives you a good idea of kind of economic growth holding in there. And if growth can keep holding in there, spread return is going to stay, in that kind of range. We just think we're better compensated on the stock side, especially at the larger cap, especially at the stronger cap balance sheet side of it, than you would be in maybe a more high yield kind of debt vulnerable side of the debt. The equation.
And let's talk a little bit more about the business of model portfolios. We had Salim Ramji, of course, the global head of iShares, on this program back in July. He said that he could see the entire model portfolio industry growing into a $10 trillion business over the next 5 years. Specifically, he said it's going to be massive. It's the way in which more and more fiduciary advisors are doing business. So 10 trillion by 2028. Where are we on that timeline?
Listen, I would say that we are well on the way within that timeline. I would give you early innings, right? If we make it, sorry, Eric, on the Phillies there, but if we make it an innings analogy, I would say we're in the sort of, the first 3 innings, right? I'm a Giants fan. We use a lot of openers. So the opener's just coming out, I think. I think as we move into the back end of that 9-inning sort of analogy, that's as you start to see it really accelerate and move quite quickly, because just the law of large numbers are going to accelerate.
You lost me on some of the baseball references, but it's early. I got that.
The Phillies got knocked out.
Okay.
Yeah, that's the Eagles won last night. That was major. So anyway, back to model portfolios. One of the reasons we're bullish on the spot Bitcoin ETFs is because of the models. I saw you guys pulled, I think it's you, 800 million out of IAU. I know you've used the gold ETF from now. I'm assuming if a BlackRock spot Bitcoin ETF were to hit the market, this would have an audience with the models, including yours. Would you work it into sort of the portfolios?
So obviously we have a filing that is in registration, so I can't really comment about the asset class 2 generally, or anything more than generally. But I would say anytime we're looking at exposures for a model portfolio, especially because we manage multi-asset, we're looking at what those drivers of return are and what those correlations are, right? And I think broadly speaking, any multi-asset manager is going to have that same decision to make at the time when it becomes, a usable instrument that's in front of them. We're not there yet, and until we get there, I can't make that any sort of ascriptions to what.
Speaking of correlations, we've seen either everything up or everything down again. We're at 1. How does that change, or what has to happen for that to change? I've heard some people say we just need to bet in to this new rate environment. That's the problem.
Yeah, well, we've been betting in for 18 odd months now, right? So you've got to ask yourself the question, are real yields, which were driving everything over the summer, sort of done at the moment? And I think especially the move that we've seen in anticipations of cuts over the last week or so, that would give you the idea that the market is making a decision. I think certainly the Federal Reserve is maybe not going to push back on the tightening that's been done for them. Listen, if someone wants to do my job for me, I'll let them do it as well. But the idea that real rates could sort of continue to move back up again as we get a little bit of a negative surprise here or there is still out there. So until we bed in there, that correlation problem is going to be there, and it's going to be ever present as it has been through 2022. We've heard from tons of advisors how bonds were supposed to be the safe haven in their portfolio, and that didn't work last year. We're hoping that sort of normal correlation returns, because in that more normal environment, you get those really strong returns from multi-asset portfolios.
Tushar, it's been awesome having you in. I hope we can get you back on this program. Tushar Yadava there of BlackRock Multi-Asset Strategies and Solutions. Coming up, as approval for a spot Bitcoin ETF looms, we'll discuss what MicroStrategy co-founder Michael Saylor had to say about how that impacts the industry. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with millennials and how much they love bond ETFs. This was a really interesting survey that we got from Schwab Asset Management that found that when it comes to millennials' portfolios, 45%, at least in this survey, had their money in bonds. That is more so than Gen X. It's more so than baby boomers. You can see that stocks is still by far the biggest category, but a lot of love for bonds when it comes to millennials, and at least when it comes to investing, more conservative than some of their generational peers, if you will. So that's bonds. But let's talk about Bitcoin, Matt, because I spoke with MicroStrategy co-founder and chairman Michael Saylor last week about the impact that potential spot Bitcoin ETF approval would have. Take a listen.
Once we get these ETFs in place, that will open up the gateway for mainstream retail and mainstream institutional capital to flow. And the halving in April is going to cut the available supply in half, and it's going to eliminate half of the natural selling. So this next 4-month period is very pivotal to the asset class.
All right, excellent interview there, Katie Greifeld. On the close.
Yes, with Romaine Bostick.
And obviously, it's a program I watch every day as well. Let's talk about this issue with Bloomberg's Vildana Heinrich,
yes,
who works with you on the cross-asset team on the other side of the building. So what do we know? What are the next milestones to watch for in terms of this ETF approval?
That's the big question because, and I think we've talked about this before, this is sort of a new process where we have so many issuers vying for a spot Bitcoin ETF, and where we have the Grayscale suit with the SEC that Grayscale obviously won. So a lot of people are still anticipating what's going to happen around that. What are the next steps around that? I think in the immediate term, we can maybe start looking for fees. So the issuers need to start coming out and telling us what they actually would be charging for a spot Bitcoin ETF. Then after that, you know, there's lots of rumors on Twitter. There's lots of speculation. I think we all have to be cautious around some of the stuff that's flying around. We'll just have to see actually how the process plays out.
And I have to say, Vildana tracks every single thing from filings that we're getting from the SEC, from the exchange, to those crazy rumors on Twitter. It is a time-consuming job, to say the least. So we're waiting for fees on the actual products from BlackRock and the likes. We have gotten a few tickers, finally. What's been happening in the realm of tickers? Are they fun, or what are we seeing here?
According to our colleagues at Bloomberg Intelligence, they're not so fun. So in the ETF space, we have some tickers, and Katie, you've written about this in the past. We have some really fun tickers where you can have something that really corresponds with the theme of the ETF. Maybe we would have thought or anticipated that some of these tickers would have been a bit more fun. There's one fun one so far. BRRR, Burr.
I mean, DeFi is cool. I actually like ARC-B as well because I know, okay, that's Cathie Wood's Bitcoin. So
right.
That's the thing, right, that Bloomberg Intelligence was saying, that these are more geared towards potentially financial advisors than retail.
Exactly. So maybe Burr would be more geared towards the retail investor base.
Of course, because that's the sound of the money printer.
That's the sound of the money printer. It's so 2020, 2021, what a throwback. Yeah. But the other ones, you know, IBTC, something a little more, I don't know, less fun, less spunky.
They're more institutional, for sure.
Yeah.
It does, you know, there is this possibility that maybe they are looking to tap, you know, wealth managers who are wanting to buy the Bitcoin ETF for their...
Tap that. In terms of the acceptance, like when they finally say, okay, you can do it, are they going to say that to everyone at once? Or is there someone first in line? Like, how's that look?
That's the other big question. So I think the hope from most of the issuers probably is that everybody gets the go-ahead, or a majority, or, you know, a big chunk of them get to go at the same time. Because what happened with the futures Bitcoin ETFs back in 2021 is that one issuer got to go first and amassed the majority of the assets, and everybody else who followed, it's not even comparable, the assets between the first one and then everybody else.
There's a real first mover, a significant first mover advantage.
Huge. So I think the hope with not just the issuers, but, you know, investors and others, is that maybe there's a bit more of a an even playing field this time around.
All right. Well, Vildana, really appreciate your time. We know you're a busy woman. Our thanks to Bloomberg's Vildana Heinrich. Now, still ahead, we drill down into interest rates with Michael Green of Simplify Asset Management and discuss the upcoming ETF on MBS next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, take it away.
Katie, today we have PFIX, which is a really interesting product, Simplify Interest Rate Hedged ETF. So the name's pretty telling. It hedges interest rates. It goes up when rates do. So it's been up a lot this year, obviously, because rates have creeped up until recently. And it does interest rate options, which are normally used by institutions. So I think this is a case of someone democratizing what will be an institutional trade. Now it's available for retail and advisors. The fee's not bad for that kind of a heavy lift, 50 basis points, and it's active. They pick and choose what options to use in order to best pull this off. Let's look at the holdings. This is a great case of an institutional-esque look of holdings here. You can see things, swaptions, right? Treasury bill. That's what you're going to see with some of these sort of derivative-based products. Now, the most important thing, let's look at the performance this year. Now, I put in TBT, which is the double-leveraged inverse Treasury ETF, which a lot of people use to hedge rates as well. And I put TLT in here, which we know everybody's been trying to trade all year. PFIX is up 39%, TLT down 10%, and TBT up 28%. This TBT suffers from daily resetting, which you don't get in PFIX, but they're both up a lot, obviously. And so, Katie, even though everybody's been going into the long end with TLT, it's this one that's been going up all year, I think, because it doesn't fight the Fed. It goes along with the Fed.
All right, Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say we have Michael Green. He is Chief Strategist and Portfolio Manager over at Simplify Asset Management. So when we talk about PFIX, obviously, as Eric just laid out, absolutely crushing it this year, up about 40% on a total return basis. I'll ask the bearish question. What happens to this fund when interest rates go down? How do you manage for that?
Absolutely. So the quick answer is it goes down. If interest rates rally, if interest rates were to go down, you would see the fund behave exactly as you would expect. It does have an interesting feature to it, though. Remember that options are highly convex. And so this is one of the reasons why it has outperformed the competing products that you highlighted, the inverse ETFs. Bonds themselves, as interest rates go higher and higher, they eventually stop declining and they begin to reflect an underlying interest rate. In the case of an option, it actually gains value. It moves further into the money and picks up what's called the delta. So it's increasing in terms of its effectiveness as it goes up. On the flip side of that, as interest rates go down, this fund, because it is ultimately using an option, has what we call ballast in the form of treasuries themselves. Those ultimately limit the losses in the portfolio to an absolute amount that's been spent on the premium or that currently resides in the premium. So in both directions, we think it's a superior way to trade bonds.
So have we seen, you think, the top in terms of rates on at the end of October when we hit 5% on the 10-year, or does that not even matter to your strategy?
Well, it obviously matters to the performance of the strategy, and it does influence some of the strikes that we're using on the swaptions. So again, the payer swaptions that we're using, we have to choose both a tenor and a strike, and the level of interest rates does influence that. We want to maintain a degree of price responsiveness. Quick answer in terms of where they're going, that's actually not why you buy this ETF. You buy this ETF because you don't know, right? If they move beyond that level, this ETF offers a highly convex, highly levered way to play the move higher in interest rates. It's useful in a portfolio, and candidly, I've gotten the interest rate call wrong this year. My partner, Harley Bassman, who developed PFIX, got it absolutely correct. He nailed it. And from the very beginning, he said, whether you think interest rates are going up or down, the answer is, if you don't know for certain, you want to ultimately hedge a component of it. And he's nailed that trade. This has been a phenomenal product.
Mike, you know, anybody listening to you talk can tell that you have done work in the institutional world. A lot of the people at Simplify have worked at hedge funds. And we noticed, I think Barron's might have, I think, reported it, that GE's pension put $100 million into EQLS, which is one of your long-short ETFs. That is really rare for an indie ETF that's new to get an institutional bite like that. I mean, really, institutions almost never come out of anything that isn't super liquid to use as some kind of operational vehicle. But to put an investment in that is really telling. Do you think we'll see more institutional investing, given that this is sort of like a hedge fund within the ETF world?
Absolutely. We think there is no question that the rule changes that occurred in 2019 and 2020 have opened up the ETF space to be competitive with hedge funds or other strategies in the institutional world. It's not just EQLS that is benefiting from institutional investment. We also have significant institutional investment in our 2-year Treasury strategy, which offers a levered exposure to the 2-year Treasury. You've obviously heard Stan Druckenmiller refer to his enthusiasm for 2-year bonds. This is a way for retail or institutions that don't have what's called an ISDA agreement that allows them to trade the complex options. It allows them to participate in a levered fashion in the same way as an institutional investor might. Similarly, we have ETFs in the bond space that offer bond hedges that are also being used by institutions. So I would highlight that this is a growing trend. GE and EQLS, which we're doing in partnership with Wolf Research as a long-short equity fund, is really just one of many examples of this type of growth.
All right, Michael Green, always great to talk to you. Hope to have you back soon. Our thanks to Michael Green, of course, of Simplify Asset Management. And before we go, of course, we can't leave without wishing Matt Miller a happy birthday. It was yesterday, but this is the first show we're doing together. So I hope that you had a great birthday talking about ETFs and efficient markets.
You know, for the most part, I was like, at least I'm not as old as Eric. That was my main takeaway.
Yeah, I'm
Just
2 weeks older.
2 weeks older.
That's why we have the same exact reference points.
I know,
There's
lost.
nothing he can bring up that I won't get.
I was talking about the guy who can't find his stapler in Office Space this morning.
Yeah.
She's never seen Office Space.
No, but
I've
I
seen it 12
smiled.
times.
I smiled pleasantly and I laughed because it is your birthday, so happy birthday. But
Thank you.
For now, that does it for Bloomberg ETF IQ. I'm Katie Greifeld with the birthday boy and with Eric Balchunas. This is Bloomberg.